we're going to find that a lot of government spending was illegal, done and washed through the NGOs, and this is gonna ripple through the economy. It's already started. New tenant rents started collapsing in the fourth quarter because when Trump got elected, there was a lot of self-deportations, and we're going to see, and just stopping the flow of illegals into the country is a second derivative effect. Forget the mass deportations. If that even starts in earnest, it's only going to accelerate the pain. Second derivative effect of the velocity of money is probably going to go lower. Tariffs are definitely affect the velocity of money. They're a negative impact. So that doesn't help the situation. But the illegals, we think the multiplier effect on illegal alien into the economy is higher than the average Joe who does save and think about the future. And also, if you want to think about the 10 to 15 million we brought in, we estimated only about 2 million of those illegals found jobs. So the rest are kind of doing nothing.
You're watching Capital Cause, and my name is Danny. It is May 2nd, 2025, and today's guest is Ed Dowd. Ed, thank you so much for coming back on the show, my friend.
Danny, great to be here. Thanks.
Yeah, definitely. We'll just dive right in here, Ed. We've got a lot of stories happening on the macroeconomic financial stage, but I want to turn it over to you and kind of see what's been occupying your headspace. What do you think should be on the radar screen for the average investor out there, considering all that's going on?
Well, we put out an economic report in January detailing our view that the U.S. economy and the global economy is in danger of a deep worldwide recession. So, economies move slow, nothing's fast. We still think our call is going to be quite good. The tariffs, we think a little bit of noise that caused the stock markets to wobble, but they're already trending down. The AI bubble burst, in our humble opinion. Our early cycle indicators, interestingly enough, after the bounce off of the bottom in 23, started rolling over again, and they're now in contraction territory starting in February. So the bounce from the bottom never got us into expansion territory, got us a little above. Now we're rolling over again. So we think as we roll through the next 12 to 18 months, Trump's policies are going to reverse a lot of what caused the economy to kind of be on life support in 23 and 24. And a lot of that was illegal immigration, and what we're finding out to be, the U.S. government funding most of that illegally, and government payroll jobs. And as that policy, the Trump policies roll through the economy, number one, stopping the flow at the border, and number two, starting to deport, shutting down these NGOs, since that was the marginal contributor to the economy and end the housing market, by the way. We're coming on an 18-year housing cycle, which just naturally happens. We think there's going to be a housing recession, housing crisis, which is 20% of the consumption economy. Consumption is 80% of GDP, and housing-related activities are 20%. So we think structurally, Trump's policies, while needed to be done from a societal standpoint, are going to cause a correction in the economy, which is well needed. Home prices going down isn't necessarily bad for those who want to buy. It's just bad for those who are over levered and own rental properties and have too much debt. So that's our call. We don't see any change to that. New tenant rents started collapsing in the fourth quarter. We got the first quarter data. There was a revision back up slightly in the fourth quarter data, but new tenant rents continue to trend down. They're a leading indicator for all tenant rents and home prices. And we think one of our bold calls is we think headline inflation will be sub 2% by the fall. Inflation's coming down. And by the way, the tariffs, a lot of confusion on the tariffs. Tariffs are deflationary. They cause demand destruction, not the higher prices on certain goods will cause people to balk and rein in their spending on the aggregate.
And you're kind of seeing that play out with the oil price. No, I mean we've hit a 5 handle on the oil price. I believe it's $58 at the time of this recording.
Yeah, and we also follow commodities. If you look at commodities, the DBC is a ticker for the Invesco commodity tracker ETF. That started coming down, and then it collapsed into the tariff noise, and then it bounced. Stocks have continued their bounce, but if you go a little, the bounce in the commodity index is nowhere near, and they're rolling over again. So commodities are kind of, price tells the truth. Commodities and oil are telling you that there is global economic weakness.
Right. And you can probably also see this in the copper price, Dr.
Yep.
Copper, right? And copper's been, I mean, it sold off. I mean, it had a puking session earlier in the month here, but it seems to have been merely a dead cat bounce on the part of this rebound here. So you can kind of see the same thing here with Dr. Copper.
Yeah. So, we're going to, I think we're going to see, hopefully, I mean, I don't want a summer of lower stock prices because I don't want people to panic, but I'd rather see kind of a demure summer. And then once people realize what's going on, we have an acceleration in stock price declines in the fall. But commodities are telling the real story. The DBC Invesco Commodity Index, it bounced and it's rolling over again. So the real economic data is going to continue to weaken in our opinion. And it's going to be driven by housing, which no one's talking about. No one's talking about the elephant in the room, illegal immigration. Elon and Doge revealed how much fraud is going on in the government and the NGO system. And so what they did, they illegally, people don't get this. Net legal migration is 1 million a year. We brought in officially 10 million, could be 15 million or 20. That was a concerted logistical operation with government involvement. And they did it they washed this illegal operation through the NGOs. So we've estimated that an illegal alien, all-in economic spend that went into the system, including what the NGO people got, their salaries, the transportation people got to get these people in, to the border, then internally into the U.S., then housing, then goodies for the illegal immigrant. You could easily see 50,000 to 100,000 per person. If it's just 10 million, that's $1 trillion on the high end, 500 billion on the low end. If it's 15, it goes. The numbers just, if it's 20. So we're going to find that a lot of government spending was illegal, done and washed through the NGOs, and this is gonna ripple through the economy. It's already started. New tenant rents started collapsing in the fourth quarter because when Trump got elected, there was a lot of self-deportations, and we're going to see, and just stopping the flow of illegals into the country is a second derivative effect. Forget the mass deportations. If that even starts in earnest, it's only going to accelerate the pain.
And it's just kind of like a two-layered government stimulus, because number one, they give them what, based on your calculations, 50 grand, at minimum 50 grand per person on average. That's not 50 grand to them. It's the whole economic. They might have gotten 20 or 30, but okay. The all-in effect on the economy per illegal was 50 to 100 grand. Gotcha.
Yeah.
And then they spend their own money that they make by, from that they earn from their jobs. They spend that money immediately. You and I were talking about this before we hit record. Illegal aliens are not going to save and invest capital into the stock market or 401ks. They're going to take that money and spend it immediately. So the turnover rate, the money velocity of the U.S. economy, it's going to start going up. When you do the reverse of that, when you start unwinding all of that, it's effectively you're bringing down money velocity. You're bringing down spending as a consequence.
Correct. And, you and I were talking earlier before the show, the velocity of money kind of second derivative peaked Q3, Q4, and now it's rolled over. We finally get the Q1 numbers. It's slightly down. So second derivative effect of the velocity of money is probably going to go lower. Tariffs are definitely affect the velocity of money. They're a negative impact. So that doesn't help the situation. But the illegals, we think the multiplier effect on illegal alien into the economy is higher than the average Joe who does save and think about the future. And also, if you want to think about the 10 to 15 million we brought in, we estimated only about 2 million of those illegals found jobs.
Mm.
So the rest are kind of doing nothing.
I see. And I've got the M2 money velocity chart here, and you can, it is decelerating. The second derivative effect is coming down. And we bottomed out, it appears, somewhere around here. Well, technically we bottomed out during COVID in 2020, but then we had a local bottom here in middle of 2021, and then we've been on the uprise of that, but it's been kind of slowing down, somewhere around the late summer, fall of 2023, and now we've kind of hit a crescendo, and the money velocity is starting to come down. And for those in the audience who may not know, because we do have a wide range of people that do watch this show, money velocity is effectively the turnover rate of money. So there's less the rate of money being exchanged in the U.S. economy is starting to peak. It's already peaked and it's starting to come down, and that is it's not a good thing.
Also, credit is tied to the velocity of money. So if credit tightens, that'll decrease the velocity of money. We're seeing some early indications that approvals for auto loans are getting harder and harder to get an approval. So that's a problem. The consumer, Chipotle came out and they warned on their earnings. I know, there was a lot of debate in the comments under my post about that. Chipotle stinks, whatever. They said the consumer is suffering. So the average Joe is pulling back, and adding a housing problem and all the ancillary parts of the economy that benefit from that.
If you're looking for great deals on gold and silver, coins and bars from a company that you can trust, then you've got to check out the good folks over at Pimbex. This year, I've really gotten to know these guys, and all I can say is you're not going to deal with a better group of people. They're a family-owned gold and silver online bullion company offering the essentials and more at industry-leading prices while always providing first-class top-tier service. That's PIMBEX.com. And if you're looking to convert some or all of your retirement account into real gold and silver, give Pimbex a call. They'll help explain the process and get you started on the right path. Your support at Pimbex also helps support the channel. So reach out to Pimbex today. You won't be disappointed. And make sure to tell them Danny sent you.
Be a problem. And it's just, there's the housing market was held up by the illegal alien influx. Even though they may not have purchased homes outright, they got a lot of the shelter, and they were renters that supported a lot of people that own multiple properties that rent to them. So that, once the rent price, new tenant rents start coming down in price, that means there's an oversupply of apartments for rent, and then just slowly ripples through the economy into home prices eventually. And we're at new all-time supply highs of new home sales. They're not selling, they're not moving. Transactions in the real estate market are slowing and stopping because really at these yields and at these prices, no one can afford them on the margin. And it's always on the margin. And if the marginal supporter of the housing market, which we believe was the illegal alien through renting, if that's going the wrong way, that's a problem.
Yeah. And I also want to show you the M2 money supply chart. So looks like we are beginning to see some movement up in the M2 money supply chart. So what do you make of that? Why are we seeing a move up in money supply, but a downward shift in money velocity? What's going on there?
So money supply, the absolute, you got to look at the growth rate of the money supply, and the second derivative, while it was accelerating the last year of Biden's term through all that spending, I suspect that is going to start to roll over, and year-over-year growth is what we pay attention to. And in November of 22, it went negative year-over-year growth, which was the first time since the 30s, which already, and then we had, I don't know if people remember, we had a bunch of bank failures in March of 23. So the banking system and the Federal Reserve did a temporary program called Bank Term Funding Program, which they lent a lot of banks money against their held-to-maturity portfolio. That program ended last year, and so I suspect money supply will roll over, and the Fed's going to have to lower interest rates quite a bit.
Gotcha.
And the 10-year yield peaked in January of this year and has been slowly creeping down. And we suspect, as the hard data and our viewpoint is right, that the 10-year yields will go down considerably, and the Fed will be chasing interest rate cuts all the way down. And, honestly, this payroll number that came out today, the payroll numbers have not been good, been very good quality data. There's a birth-death model. They revised down February and March, I believe. So that's almost like what happened during the Biden administration. Good headline number, but then quietly revised down the other numbers. I suspect this actually makes me more bearish because people think everything's fine. And if you're an investor and you think, oh, Trump's economy is already booming, Trump's policies have not taken effect yet. And to ascribe all this investment in Q1 to him is insane. I think that was just a lot of plans that were coming to fruition. And I saw a chart where 1% of GDP growth last quarter was due to data center spend, which we know is AI driven. It was a huge amount of data spend. The plans for that occurred last year, and they finally got implemented. I think we just peaked out in data center spend, and I think the second derivative on AI is going to be lower and lower growth to a halting of AI spend. That's my guess. If you look at the stocks, the AI bubble stocks, they're already discounting that. Nvidia's already rolled over. It really kind of peaked out from a relative performance standpoint in July of last year. And that's when their gross margins peaked and started coming down. So Nvidia, in my humble opinion, is kind of telling you the story that the glory days of AI are behind it. And, the stock is probably going to, have, vicious rallies and then vicious sell-offs. And then eventually they'll miss earnings. And then people will see that the AI bubble is over.
Yeah, it seems like it's below all of its moving averages as well. So classic downtrend sign here. I want to go back to the 10-year really quick, because you did mention that you see more weakness on the 10-year yield, but that also implies that you see strength in the U.S. bond market. Can you explain that really quick?
Well, if we're right on our recession call, and bonds have been one of the biggest underperformers for we've had one of the worst bond bear markets ever in the history of, in the longest time. So asset allocators are overweight equities, underweight bonds. And if we do go into a recession, bonds do very well in a recession. There's a flight to safety. And so if we're right in our call, bond yields are going to be a lot lower than they are today. But they peaked in January of this year. And we suspect that's the early warning sign that the bond market's starting to discount slowing growth in the economy.
Why is it, do you think, that when we did see that Liberation Day series of corrections, I believe like the NASDAQ was down 20% from its high at that point, why is it that the 10-year yield began, you see it's spiking here, meaning that bonds were not being bought? This kind of goes against conventional wisdom when, we've been taught to expect when the stock market corrects, the bond market gets a bid, but it wasn't necessarily the case here.
Well, so there was tremendous margin calls globally, and people sell what they can, not what they want to. That was when this happened, I talked to a bunch of people, asked me that question. I said, this will subside. This is just a bunch of people getting kicked out of their positions and having to meet margin calls.
Okay, gotcha. But then you also saw gold hold up fairly strong from a relative basis as well. Any thoughts on gold's performance? Gold seemed to have done, it appears to have been the best performer um, in the show a few weeks back, and it's been correcting down. It's got slow descending wedge here, but we did hit a high of
That looks
3,500.
like a bullish descending wedge. That'll probably break
Yeah.
out, is my guess.
Mhm.
So gold. So gold is, you know, I was suspicious of gold primarily because it's a commodity like everything else. But however, I've recently been enlightened as to what's quietly going on in gold around the globe. Basel III implementations are starting to hit on July 1st of 2025. The U.S. will consider gold tier one capital.
Mm.
The banking system is quietly making gold money again. In 1971, we turned it into a commodity and delinked from it. This is a relinking quietly. I think the gold market is going to be a big part of whatever monetary reset is coming. Physical gold. Paper gold is not tier one capital. ETF, like the GLD ETF, is considered tier three capital. So what that means is not only are gold bugs and central banks buying gold, banks are going to buy gold because it's tier one capital, and you can make loans against it. So this is a big deal. This is physical gold, not paper gold. So I think gold is not only, you know, an indicator of uncertainty and a hedge against uncertainty, it's also becoming money again, and that has huge implications. So that means gold, in my humble opinion, is going to go a lot higher with, you know, with some sell-offs here and there. But I think gold is likely, the chart looks like it wants to go to 4,000 this year, and then eventually maybe 10,000 by 2030. If this is going to be the trend, you know, the gold is telling me something, and gold, what it's telling me is they're quietly making gold money and important again.
Yeah, and I've been hearing this from another one of my good friends and guests on the show, Rob Keynes. He's been saying that from what he's seeing, it's becoming, there's this push at the state legislator level to make gold legal tender. You see this happening in Florida, you see this happening in Texas, a bunch of other states as well. So it appears to have started, like you said, but it's kind of under the radar. I mean, not many people are talking about it.
You know, the reason why they're not talking about it is the love affair with Bitcoin, which, you know, I'm not going to get into arguments with Bitcoin people. It's become a legitimate asset at this point. The only problem with Bitcoin is that it's, you know, 95% correlated to the NASDAQ. So it's very volatile, and it doesn't appear to be going to be given tier one capital status anytime soon. So people, I think quietly the authorities are acquiring gold while everyone, you know, the citizenry is obsessed with Bitcoin. You know, if I'm a betting man, I go with where the monetary authorities are going. And if I had to choose between Bitcoin and gold, I'd buy physical gold.
Right. So Bitcoin has, you said it's been following the NASDAQ. If you look at the NASDAQ Bitcoin over the NASDAQ, Bitcoin's been slightly overperforming it, but yeah, it is pretty much tied to the NASDAQ. What about oil? Oil is at $58. I guess this kind of ties into your commodities call, right?
Yeah, look, oil is telling you the global economy is having issues, and that's you know, yesterday when the stock markets rocked and rolled, you know, oil went down 3.5%, and commodities dropped overall as well. So while we're having a stock market, you know, rebound, watch commodities. I mean, the famed short seller Jesse Livermore figured out when to short the 29 bubble by watching commodities. I'm not suggesting we're going to have a 29 stock market crash, but like always watch the price of real things versus, you know, the stock market, which is, you know, it's prone to, you know, childlike behavior and euphoria.
Yeah. In regards to the tariffs, it appears that China's been walking back a few of these tariffs, 25% of which account for $40 billion in trade. Is China coming to the table here? What's your take on as to what's going on between the dealings between the U.S. and China?
Well, when the tariffs first hit, there was a lot of gnashing of teeth, people calling the Trump administration stupid. The way they calculated the tariffs, was not communicated well. But Carlos and I put out a free piece on our website at financetechnologies.com talking about what we thought they were doing. Basically, they were targeting the end goal, which is net trade of imbalances of zero. And the whole idea was just to get people to the table, because if you went through every country one by one and every trade deal, it would take months to sit down. So it was just a way to get people to the table fast. And that looks like it's working. Also, at the bottom of the tariff tantrum, I said, look, we're oversold, and the news flow over the next 4 weeks is going to be people coming to the table, and the markets will go up on that. And that's where we are. So we're back. The markets are back to where they were basically Liberation Day. They'd already peaked in February, so we're not back anywhere near new all-time highs. So my guess is as we roll through the summer and fall, stocks will eventually figure this out, that the economy's rolling over. But the tariffs, if you want, I didn't make a call for people to do this because I'm not into short-term trading, but a lot of people were smart. A lot of my friends bought that low after being short into that low, and they said the news flow will only get better. So that's where we are. We're in the part of the story where Trump's going to announce deals, whether they're real or not. That's where we are. That kind of talk and chatter will lose its luster over the next several weeks as we roll through the real economy.
What do you make of these arguments from people on the other side who say that now that that the vase has been essentially broken? Sure, you can kind of glue the vase back together, but it's not the same. You've kind of created this environment where you've shown that you will go this route. It kind of damages relationships because from what I've been hearing is in China, a lot of these Chinese businesses are just going to not risk dealing with the U.S. anymore because they just see it as too risky moving forward, given the unpredictable nature of U.S. trade policy.
Yeah, they can say that, but in our economic report, we looked at trade wars and trade. What we thought, we thought trade tariffs and negotiations were coming at the time we wrote the report, and we looked at what's the reality of the trade imbalances, and the U.S. consumer is the consumer of last resort for these countries that are exporters. Mm-hmm. And China's economy is still an export economy, so they can say that they're going to not sell to the U.S., but that isn't going to fly. We checked recently what's the non-financial corporate sector debt in China. It's 26.5 trillion in U.S. dollars. So they can say that, but they have to come and deal. That's just talk, in my humble opinion. There's no other consumer they can find, and Europe's a basket case.
Interesting. Why is it that we're seeing some of this weakness in the DXY? Why is the dollar getting relatively sold off to some of these other currencies? The dollar, I have a friend, his name is Tim Wood. He does the cycles research newsletter, cyclesman.com. He's been very good at tracking long-term cycles on big asset classes, the dollar being one of them. It has a 4-year cycle from one low to the next low. And if you look at the long-term chart of the dollar, it bottomed in the great financial crisis, and every 4-year cycle low has been higher than the previous 4-year cycle low. In the summer of last year, he was calling for a 4-year cycle low in the dollar in first quarter or second quarter of this year. And it looks like we're about to get it. There might be one more push down, but it makes sense as to why the dollar went down like it did.
when you are a foreign purchaser of stocks, when you buy the stock, you sell your currency, buy dollars, then buy the stock. The reverse happens when you sell U.S. stocks. You sell the stock, you sell the dollars, and then you convert it back to your currency. So the 4-year cycle low is coming. The dollar went down primarily due to a giant margin call and selling of U.S. securities. You got to remember the allocation into stocks globally versus bonds is way overskewed, and it's going to take time, but we think that'll reverse over time, and we'll get back to more normal allocations.
Speaking of allocations, when you look at the gold price relative to the stock market, let's say gold divided by the S&P, I mean, this thing is pretty much dirt cheap. Should we anticipate a significant mean reversion somewhere at a much higher level, let's call it some arbitrarily high level?
Yeah, I think so. I mean, look, we've hit all-time high valuations in February of this year. And Carlos and I did a free piece on the dividend yield of the stock market versus the bond yields and the risk reward. And when we had gotten to levels where if you bought a stock in January, February of this year, we put the piece out I think in February, your 10-year forward returns were going to be dismal. So we have a lot of froth to work off of in this basic huge stock market bubble that we just experienced. And that's also why it was easy to make the recession call, because stocks were pricing in great news, and bonds were pricing in yields going higher. And if we're right on our economic call, that's all going to reverse.
And with gold sitting at a $20 trillion market cap or somewhere around that, I mean, it's relatively small compared to the stock market. This kind of seems to help your thesis over about a $10,000 gold price tag by 2030, because the stock market is well worth over north of $20 trillion. So it's a fairly big there's tons of asymmetry here.
Yeah, and one of the things that I'm doing going forward is I have a friend of mine. He's involved in physical gold, and I will be probably helping him out in that business as well, because I think the physical gold world is going to have a bull run for a long time. So as a businessman and looking at opportunities, I'm going to help him find buyers of gold. And I'm not talking small. I'm talking 25 to 100 million type size. So that's what we're going to be doing over the next several years.
Wow. So you see some bullishness ahead for the gold mining stocks as well?
The stocks are harder. I wouldn't make that call. I'm bullish physical gold because they're making money again.
Why do you think that we're seeing, number one, we're seeing record gold prices, but we're also seeing some pretty low oil price action? The delta between the two, you could look at that as kind of like the margin or a proxy for the margins for these gold mining companies, but they're still lagging far behind the physical gold price. I mean, it seems like they've got pretty much everything they could have asked for, but they're still not getting a bid.
Yeah, gold mining stocks have been frustrating for a lot of people. It's expenses are high. There's always risk in countries where they're doing certain operations. And they're not the most well-managed companies on the planet.
Gotcha. Well, I think we've covered pretty much everything. We went through all the asset classes I had lined up for us here, Ed. Anything else you want to bring up before we wrap up here?
No, I mean, my work on the disability data came out today, and we're flirting with a new all-time high. the trend is not your friend. That's something that, will have economic implications if that number continues to rise, which, you don't want a large portion of your population getting disabled and becoming uneconomically productive, and then you have to spend resources to take care of them. So that's a trend that we continue to monitor, and it's not going the right way.
And you're pretty much the only person the only economist or analyst looking at this stuff, I believe. I haven't heard of anyone else tracking this.
No, and interestingly enough, the immigration hit a lot of this. This would have been a big problem economically if it wasn't for the illegal immigration papering over that kind of those numbers. Had we not had 10 to 20 million people come in, this would be affecting the economy.
Yeah. Well, we'll continue having you on and getting updates and monitoring the situation. We'll see. It looks like we're at a pivotal point with the M2 money velocity coming down. So it's not a good sign like we talked about. So we'll see what happens down the line here. Ed, thank you so much for coming on, my friend. Where can people find you if they want to learn and see more?
Yeah, if you're an institutional investor, high net worth individual, we have a report available for sale at financetechnologies.com. And we also have a lot of free research there as well. So you can go to our free resource page. You can buy the report. And you can also follow me on X at Dowd Edward, DOWD Edward. I'm constantly putting out different things that, obviously make my thesis look good. So, beware, I'm biased on my own research.
Excellent. Well, hey, thank you so much for coming on, Ed. Guys, if you enjoyed this podcast, drop us a like and comment "Go Ed Go" in the comment section. If you disagreed with anything, that's fine too. Let me know why, though. I do read the comments. So drop me your comments down below, and any sort of liking, subscribing, commenting, that really does go a long way in helping us boost these videos in the algorithm. So if you'd like to help us in that regard, then you know what to do. Help us get these videos out to more people. Also, check us out on Substack. It's capitalcosm.substack.com, where you can get early access, ad-free versions, and uncensored versions of all of my shows before they come out to the YouTube audience and for the ones that warrant it. And check out our good partners over at Pimbex. It's PIMBEX.com for all of your gold and silver buying needs. All right, guys, thanks for watching. I'll catch you later. Bye.